The big players are chasing the bright lights of Auckland, but what if the real gold mine lies in Christchurch and Dunedin? They're quietly defying expectations, offering higher rental yields and more stable property values than the so-called hotspots. Investors with a vision to look beyond the big cities are poised to reap their rewards. Joining us is Kelvin Davidson, Chief Property Economist at Cotality, here to share why these regional cities aren't just the future, they're the present. Before we get into it, if you're serious about property, start with the Mortgage HQ Snapshot. It's ripped the lid off the game for thousands of Kiwi investors. No fluff, just a sharp look at the real options. Descriptions below, take the shortcut. Kelvin, why are Christchurch and Dunedin the hidden gems of New Zealand's property market in 2025?
Well, I suppose I'd say I'm not thinking that anywhere is necessarily strong in an absolute sense. Even in Christchurch and Dunedin, there are some pressures. I mean, everyone's facing the cost of living. There's lots of supply wherever you look. Listings are abundant, both in terms of rentals and properties available to buy. So, yeah, I'm not thinking that Christchurch or Dunedin are necessarily booming, and we're not seeing that in the house price figures either, for example. But what they are doing is, I guess, showing more resilience compared to other parts of the country. So there's an absolute and relative thing going on here. They do look relatively, I guess, more resilient compared to other parts of the country. Certainly, say Auckland and Wellington, but not necessarily booming in their own right. But yeah, I suppose one thing that people are picking up on at the moment is, I mean, Dunedin's always a bit of a sort of quirky market, I guess, with the students and the huge seasonal flows of property demand that you can see in that market. It's always a little bit jumpy from quarter to quarter and year to year, but generally, from what I hear, there's still a good number of people who are find Dunedin pretty appealing, keen to live there. Certainly in a Christchurch sense, you hear that. And Stats New Zealand put out some data a couple of months ago on internal migration flows, and there's definitely been a north to south drift, and Canterbury has been one of the big beneficiaries of that. Christchurch City to an extent, but I mean, when I think of Christchurch, I really think of the greater Christchurch area, a super city, if you like. I definitely include Selwyn in that, Rolleston. I think really now is part of greater Christchurch, and going up into Waimaka area as well. So those you certainly hear a lot of anecdotes about people pretty keen to move to Selwyn, either from out of Christchurch City or from other parts of the country where maybe they're a second home buyer. They thought, okay, well, what can I do? Shall I trade up where I'm living? Maybe get a bigger house, or maybe a perceived better house, but it might still be an older house. Whereas I can move to Selwyn, move to Rolleston, get a nice new build, decent price, good bit of land. I'd be pretty happy there and still commute into Christchurch pretty easily. So, yeah, I think probably to the extent that there's a hidden gem or a sort of jewel in the crown, maybe it is that sort of wider Christchurch market where people can still get good value and get a quality property too.
And how do the 4.2% yields in Christchurch and 4.4% yields in Dunedin compare to other cities, and what does this mean for investors?
Yeah, well, they're better. From an investor perspective, they're higher than elsewhere. Auckland's down at sort of 3%. Wellington's maybe in that sort of 3.5% range. So, yeah, to have Christchurch and Dunedin above 4 is at least in a relative sense, pretty good. I suppose, even at 4% rental yield, yes, it might be better than say Auckland, for example, or certainly say Queenstown. The yields in Queenstown are more like the 1s or 2s. So, it might be better in a relative sense, but the fact is you've still got to be paying the mortgage. The mortgage rate's the same wherever you go. And generally, whether you might buy an individual property that's cash flow positive, but generally, whether you're in Auckland or you're in Christchurch, we're probably still seeing top-ups on a pretty standard rental purchase. So, yeah, the top-up might be smaller in Christchurch, but it's probably still going to be there. So that's something I guess people need to be thinking about. But certainly at face value, you take a 4% yield over a 3%, and potentially the thing is that the values are lower in Christchurch or Dunedin, so maybe easier to raise that deposit from an investor perspective. Deposit's still pretty important for investors under the LVR rules. Still definitely needing 30% at least on an investment property under the LVRs. So, or an existing property, I should say. New builds, maybe deposits are a bit less than that, but certainly on existing properties needing that 30%. So still pretty important, and buying in a slightly cheaper market. Not saying it's cheap, but a cheaper market. that deposit might be a bit easier to raise, or the cash you have might stretch a bit further. So yeah, they will look a little bit more appealing. But I mean, I guess the investor comeback, what we are seeing in the data is that it is pretty consistent, even in a market like Auckland. We are seeing that market share rise for mortgaged investors. We're seeing it rise in Christchurch, so it is a pretty consistent thing. And I guess, there's just that sense that mortgage rates are coming down. So yes, okay, the top up in Auckland might be higher than Christchurch, but it has come down from where it was. So people are sort of buying into that.
It certainly looks like there's been a lot of first-time buyer activity in Christchurch. And what do you think the role of the local economy and migration patterns is playing on the Dunedin and Christchurch markets?
Yeah, I think that's afford. You always come back to affordability. That's sort of it doesn't tell you everything about a property market. There's going to be local factors, and there's been plenty of times in the past where economists would have said, look at affordability. It's horrendous. House prices can't rise ever again because look how stretched affordability is. Yet they always tend to. So affordability doesn't necessarily tell you everything about a market, but I think it can tell you a direction of travel and maybe how strong demand is, the appeal from people living outside an area. Might be looking at affordability and, okay, might still be a stretch, but it's looking a bit better than some other parts of the country where they might be thinking about. So, and Christchurch definitely stands out on that right now. Dunedin too, housing affordability is better in those markets than in other parts of the country, especially if, say, you manage to have your Wellington salary or your Auckland salary and you thought, okay, well, I can keep my current job, maybe commute a bit, work remotely, I can keep my current job, keep my current salary, and save. I mean, you look at, say, the difference in median property values between Auckland and Christchurch, for example. You're talking $350,000, somewhere around there, off the top of my head, 300, something like that. So, big difference if you can keep your same salary. So affordability is a pretty clear kind of attraction there. But again, first home buyers are still pretty robust in Auckland too. They're pretty robust in some other expensive North Island markets, Tauranga, these kind of areas. First home buyers, it's been a really big success story of the housing market in general, I'd say, over the last 3 years, really. So it's not just a Christchurch story, but the people talk about the lifestyle benefits. It's a bit of a vague term. I mean, I think most parts of New Zealand would have some kind of lifestyle benefits, so I'm not sure how much that really holds up in my mind. But certainly, affordability is a factor. There is I guess a confidence thing around Christchurch and then Greater Christchurch and the Canterbury region at the moment, so that's probably a factor too. But yeah, certainly affordability, and the flip side of that, I mean, for first home buyers, affordability is what you'd sort of think of it as. For investors, but I suppose the other side of that same coin is better rental yields, smaller top ups. So that's kind of the analogy for first home buyer affordability is for first home buyers, perhaps that cash. I mean, for investors, I should say, that cash flow position perhaps looks a bit better in somewhere like Canterbury. So yeah, lots to weigh up.
And how is the infrastructure development and city planning impacting and contributing to long-term growth prospects for Christchurch and Dunedin?
Well, gee, I can't say too much about Dunedin, really. I don't know that sort of inside out, but certainly from what I understand, the Dunedin Hospital, I mean, that would be the big project that people would talk about in Dunedin at the moment. From what I understand, it's a little bit slow moving, but that is a big influx of cash into that Dunedin market. Lots of workers, lots of extra spending around those associated industries. I don't know to what extent other infrastructure is being developed around that market, but certainly that hospital is a big influx there. Canterbury, yep. I suppose the issue for Christchurch and Canterbury and Selwyn is I mean, there is some decent infrastructure spend on roads and schools and things, but the issue is the population growth is still so strong that struggling to keep up. So it's, I suppose, with infrastructure, it's about getting ahead of the curve in some ways and actually spending more than what the current population growth is requiring, because of course you're going to continue to need more in future as well. So yeah, it's again horses for courses. It's all about relative, each market, how much infrastructure is being developed relative to what the demand is. And Canterbury, Selwyn in particular, is a very fast growing part of the country. I think pretty much the fastest. So lots of infrastructure spend, but a lot more required too. So, but yeah, those things all help. Infrastructure that's in the right place, well located, well built, that's going to, I guess, create its own housing supply. people can see, yep, that's going to be profitable to put housing in there. People will buy it. So it's a bit chicken and egg, but there's certainly some reasons, I think, to be fairly positive. And the current government's pushing very hard, obviously, on all sorts of housing supply measures, infrastructure measures. So we have to hope that sticks through the political cycle. But at the moment, I think there's reasons to be a bit more optimistic about that, certainly in terms of land supply, helping with getting that housing supply coming through.
And OCR announcement is coming up shortly. What are your predictions and what are the repercussions if they decide to hold?
Yeah, I think so. We've got a couple of weeks until the next monetary policy statement, August the 20th. At the moment, yes, our latest CPI number for Q2 went a little bit higher, so we went up from 2.5 to 2.7. Not ideal, but if you look underneath the numbers, the non-tradable or domestic inflation, which has been the problem for quite some time, has started to slow. So we're seeing home insurance premiums perhaps flatten off a little bit, still high. But at least the growth rate is flattened off. Keep in mind, inflation's a growth rate. It's not the level of prices. So, petrol could cost you $10 a litre, very expensive. But if it's always been $10 a litre, there's no inflation. So keep in mind that inflation's a growth rate, not a level of prices. So same thing for things like home insurance. Might still cost a lot, but at least from my own perspective, my own premium actually flattened off in the last 12 months. So that's, that might be starting to feed through. Other things like rents have obviously gone flat. So there's a sense that non-tradable domestic inflation is starting to cool a little bit. On the flip side, we've got a little bit more concern, I guess, about tradable or imported inflation, global conflicts. All of that is perhaps putting a little bit of upwards pressure on that side of the equation. But overall, yes, not ideal to have that Q2 inflation number ticking up, but it was less than what people had been fearing, and it was pretty much in line with what the Reserve Bank expected. And they said, well, at their last OCR decision, where they held the OCR unchanged for the first time in, I think it was about 6 or 7 meetings, they wanted to pause for breath. They said, well, look, yep, we might be pausing now, but if the economic data evolves as we think, we're pretty likely to cut again at some stage, and probably August. So I think the CPI number wasn't ideal, but it was probably in line with what people were expecting. Was or at least what the Reserve Bank was expecting, and a little bit better than what the bank economists were concerned about. So I think okay, it might be up for interpretation, but it feels like things are evolving pretty much as the Reserve Bank thought. They said if that happened, they'd probably cut again. So I think we get to August the 20th, they've got a chance to full monetary policy statement. So they've got a chance to publish all their forecasts, all of their detailed thinking, update all of that. So I think that gives them a good basis to deliver a cut. So I think on the 20th of August, I think we'll see a cut, takes the OCR to 3%. But that might be getting pretty close to the end. We've had some pretty decent OCR cuts. Estimates of neutral are sort of up for grabs, a little bit subjective, but we're getting pretty close to the end of this cutting cycle, where the Reserve Bank will remove any sort of, I guess, predetermined path, and then it'll just be about watching how things evolve, watching and waiting. So potentially another cut on the 20th. In terms of mortgage rates, well, potentially they've probably already priced this in. We haven't seen a lot of change in mortgage rates lately. They seem to have probably reached that sort of broad floor. No, crystal ball there. I don't know for sure, but it feels like things have slowed down on that front. So now it seems the big thing for borrowers is deciding how to operate in that environment. Do I still float a bit? Do I start to fix a bit longer? Do I do a bit of both? So there is those seem to be the decisions coming in. And yes, there's a lagged impact here. Okay, if current market rates have flattened off, people will still see benefits because they're going to be going from their old rate of 6%. If you look across the stock and mortgages, people are still paying on average about 6%. So there will still be a lagged impact coming through here as they will reprice off fixed loans down to about 5% or a little bit less. So there will still be that lagged impact. But in terms of current market rates, it's more about, I guess, how do I operate in this environment, and do I fix longer, do I float, these sorts of things. So look out for another OCR cut, but it's in terms of housing impacts, probably fairly limited.
Kelvin Davidson, Chief Property Economist, Cotality. Thanks for your time today.
Thank you.
Before we go, you can keep guessing or you can own the formula, because the wealthy don't wait for permission, they move. Quietly, strategically. I've written the playbook, they never share. the 3 property formula, the exact blueprint thousands of Kiwis have used to build real wealth through property. Grab your copy today and give yourself the unfair advantage the rest will miss.